All right, let's dive right in. Today, we're putting together a no-nonsense 5-minute playbook for a super powerful candlestick pattern that can give any intraday trader a real edge. We're talking about the pin bar.
So you might be wondering, can a single candle, just one, really tell you that the market's about to flip? Well, in the crazy fast world of intraday trading, you need signals that are crystal clear and quick. And believe it or not, one candle can tell the whole story of a battle in the market and signal a major turning point. That signal is the pin bar, and we're about to tear it apart. So, meet the pin bar. Now, this isn't just some random shape on your chart. Think of it more like the final dramatic scene of a fight. It's a visual record of a sharp price rejection, where one side tried to shove the market in one direction, but got powerfully beaten back. It's that story of conflict that makes it such an incredible reversal signal.
Okay, but here's the catch. Not every candle with a long wick is a real pin bar. You gotta know the difference. There's a blueprint, a kind of visual checklist you have to follow to spot a valid, high-probability setup. Let's get into the nitty-gritty.
Okay, check this out. On the left, you've got the bullish pin bar. See that long lower tail? That's the story of sellers trying to drag the price down, but the buyers just stormed back in and forced the price to close way up near the top. Sellers got rejected, plain and simple. Now on the right, it's the opposite story, the bearish pin bar. Buyers pushed up hard but then got absolutely slammed back down by sellers. In this case, it was the buyers who were rejected.
Now, if you remember one thing, make it this. This is the golden rule. For a pin bar to actually mean something, that long wick, or tail, has to be at least twice the length of the candle's body, at least 2 times. Anything less, it's probably just market noise. 2x is the minimum for a powerful rejection signal. So beyond that 2x rule, there are 3 other things that are totally non-negotiable. First, the body of the candle has to be small. That shows the market was undecided before one side got that decisive rejection. Second, and this one is so important, context is everything. A pin bar floating in the middle of nowhere is basically useless. But one that sticks out at a key support or resistance level, now that's a powerful signal. And finally, and I can't stress this enough, you have to wait for the candle to close. A pattern isn't real until it's fully formed. Don't jump the gun.
So, you've done the work. You've identified a valid pin bar. What now? Now, it's time to act. Let's build the actual playbook for how you execute the trade. This is where all that chart reading turns into a real plan.
You've basically got 3 ways to get into the trade, and each one has a trade-off. You can be aggressive and just jump in at the market price the second the pin bar closes. You'll get the best possible price, but it's definitely riskier. Or you can wait for confirmation. That means you wait for the next candle to break past the higher low of your pin bar. You get a slightly worse price, but the trade has a higher probability of working out. And then there's the retracement entry, where you try to get in if the price pulls back about 50% into the wick. It's a fantastic price, but you seriously risk the trade taking off without you.
You know, one of the best things about trading pin bars is that they practically tell you where to put your stop loss. The whole trade idea is based on that price rejection at the end of the tail, right? So your stop loss just goes a little bit beyond that tail. Simple. If the price goes past that point, your idea was wrong and you want to be out of the trade immediately. Just add a tiny buffer to avoid getting shaken out by random market wiggles.
This isn't just some catchy phrase, it's a professional standard for a reason. To actually make money long-term, your winning trades have to be bigger than your losing trades. A 1-to-2 risk-reward ratio means you can be wrong half the time and still come out profitable. So before you even think about clicking buy, you have to make sure the potential reward is at least double your potential risk.
Look, your exit is every bit as important as your entry, and you need to have a plan before you're in the heat of the moment. You could have a fixed profit target at the very next support or resistance level, or you could use a trailing stop to lock in your profits as the trade moves your way. A lot of traders use a hybrid approach. They'll take some profit off the table at the first target and then let the rest of the position run.
Okay, let's level up. Spotting a pin bar is good, but spotting a high probability pin bar is what really separates the pros from everyone else. And we do that by looking for something called confluence, when multiple signals all point to the same thing.
This should be the very first question you ask yourself, always. Location, location, location. Is this signal showing up at a place on the chart that actually matters? Because honestly, context is everything.
Think about it. A pin bar right at a major support or resistance level, that's a huge signal. It's showing you that other big players are defending that exact price. But a pin bar out in the middle of no man's land? That's just noise. It doesn't really mean much.
Next up, you gotta ask, are you trying to swim with the current? Or are you fighting against it? Because while pin bars can signal major reversals against the trend, your highest probability trades are almost always the ones that align with the market's dominant momentum.
So, for example, if the market is clearly trending up, a bullish pin bar after a little pullback is a classic buy the dip setup. You're just going with the flow. You can use a simple tool like a moving average, or just look at a higher time frame to quickly see which way the river is flowing. Trading with the dominant trend just puts the odds a little more in your favor. And hey, don't forget to glance at the volume. A pin bar that forms on a huge spike in volume, that tells you there was a massive battle with a very clear winner. It suggests that institutional money, the big fish, are involved. High volume is like the ultimate confirmation. It adds some serious conviction.
All right, we've got the playbook for what to do. Now let's talk about what not to do. Knowing the most common mistakes helps you set up guardrails to protect your account and, just as importantly, your confidence.
So here they are, the 4 horsemen of pin bar trading failure. First, confirmation bias. That's when you see what you want to see, not what's actually there. Second, ignoring the trend and trying to fight a freight train. Third, jumping in before the candle closes, a classic rookie mistake. And finally, the biggest one of all, terrible risk management, which means trading without a hard stop loss. Let me give you a simple mental trick that'll keep you out of so much trouble. The absolute best, A+ setups. They're obvious, they're clean, they meet all the criteria, they're at a key level, they literally seem to jump off the screen at you. If you're sitting there, staring, tilting your head, trying to talk yourself into why it might be a good pin bar, just walk away. It's not the one. Let this one really sink in. In the intraday market, things can go from 0 to 60 in a flash. A mental stop is not a stop loss, it's a wish, it's a hope. A real hard stop loss order that's actually in the system is the only thing that will protect your capital from a sudden, catastrophic move against you. It is your non-negotiable safety net. And that really brings us to the end. You now have the complete blueprint. You know how to spot a valid pin bar, the different ways to enter, how to manage your risk, and how to use pro-level filters to boost your odds. But look, knowing the playbook is only half the battle. The real key to success, the thing that makes or breaks a trader, is having the discipline to actually follow the plan every single time. So the real question isn't whether you have the knowledge, it's do you have the discipline?